Oh, that's helpful. Okay. Well, hopefully we're broadcasting. Um, where's the thing where I can see? Oh yeah, look at that. It shows me that it's working. Oh, this is so great. All right, so we will give it a couple minutes to see if anyone jumps on with us, and then we'll just chat. And
Awesome.
yeah, people can have their questions answered whenever they are free. I'm going to text Scarlett really quick and have her check on us. All right. All right, friends. So we're not going to make you wait too long if you're watching this video when you're not here with us. I want to introduce my friend Amy Thompson with Guardian Mortgage, who graciously decided to take this maiden voyage with me into live streaming on Facebook and YouTube. I will try to pay attention for comments, but they're on two different screens. So if I miss ya, my bad. I invited Amy because she is a rock star lender, and she is, I don't know if I should class myself with her, but she is got the same kind of problem solving, figure it out attitude that I like to think I have when I come to my clients. So I think she's a great resource to talk about what's going on in the market right now, you know, how we're trying to figure things out for home buyers and make things a little more affordable and just navigate this little bump we're in the market shift.
Thank you.
Yeah. All right. So one of the things I was hoping you would tell us about, Amy, is what are some of the changes that you've noticed in the market over the past few months?
So I think that definitely interest rates is what's first and foremost in front of everybody. And so as the rates have come up, I feel like a lot of people's focus has come to they want discounts on houses, lower prices, price reductions. And I'm feeling like that's not necessarily always the best scenario. So what's changed is that with that, we've had to come up with some alternative ways to look at things that actually put buyers in a little bit better position, as well as put sellers in a little bit different position as well. So we've started to look more of things of asking for maybe credits to buy out mortgage insurance, some creative thinking on buying down rates, and just kind of some restructuring so that we can make that payment still work, even though we're looking at those little bit of higher interest rates and we're still managing to fit those payments within people's budgets.
Cool. You know, one of the things we were talking about earlier that I thought was so interesting is, you know, obviously math is not my go-to, but I think everyone's kind of first thought when they're trying to save money on their mortgage is to bring down the offer price. And I always have a hard time like walking my clients through this of like, man, even if we offer $25,000 less, that's a lot of money that the seller has to give up, but it doesn't actually change your payment that much. Sometimes some of those things you were suggesting, getting a credit towards buying down your interest rate or buying out your mortgage insurance, things like that are going to have a more tangible effect on your monthly payment. So you can create these win-win scenarios, right? Where the sellers get to keep more cash instead of doing a huge price reduction, and the buyers get more affordable mortgage.
Correct. I'll give you an example. I ran a number scenario for one of my clients last night, and we were looking at a house that was 450,000, and they asked me to run the scenario on 420,000, and it literally made $192 a month the difference in their payment by that 25,000, which or 30,000,
32, yeah.
which is an amount of money. But if you were to take maybe 10,000 instead and buy out your monthly mortgage insurance, that could save you about $200 or $250, depending on where your level of mortgage insurance is. And so Whereas then the seller is not taking such a reduction that they may not be able to take. We've run into that a little bit. But you're actually getting a longer term benefit for that because you're buying out that mortgage insurance that's gonna go the life of your loan and may actually get you a lower monthly payment than just asking for a reduction.
Yeah, it's things like that where it's like there's definitely not a one size fits all solution for everybody. But one of the things I like working with you and some of the other lenders I partner with is you guys have a lot of tools in the box of
Yeah.
like, well, let's work with what you have and what the deal is with the house we're trying to buy, and see how we can tweak it and change it to make sure it's working best for everybody.
Exactly. And it literally is different for everything. Every house, every offer, every client, we might be structuring that a little bit different. So if you're house shopping, we might be running numbers on one property in one direction and we might be looking at another property in another, just kind of depending on where the numbers are, and what makes sense for the client. And so it's really best. I will have my clients send me their list. What are you shopping for? Give me your, houses that you want to go look at, and I will run a scenario for each of those. And they're all going to be a little bit different, structured a
And
little different.
that's incredible. You are a good lender.
It takes a bit of time, but we get it done.
That's awesome. All right, so let's talk for a little bit about kind of what's going on with the interest rates. Like, where are you seeing them sitting now, and where do you expect them to go over the next 6 months?
I wish I had a crystal ball.
Don't we
I'll
all?
say that. Yeah, don't we all? Right now, they're sitting anywhere from high sixes to mid sevens. It kind of depends a little bit on what we're doing, what the structure's looking like, down payment, different kinds of loan programs. Most FHAs are still kind of in those high sixes. Conventionals sitting a little bit higher. Of course, there's a plus and minus to both. So definitely not a one size fits all there, but I'm hoping that they're kind of leveled off for a little bit. They've kind of just been on this slow little creep up after we had our big jump. And we're kind of hanging around an area now. Where they're going to go, I have no idea. They could today might be the best time to get into the market. You might be buying in at the absolute lowest interest rate now. I think that waiting for an interest rate to change and come down is probably
It's
not the
risky.
best.
Yeah.
That is definitely not the best strategy. You've got two options. Today might be the lowest interest rate you're going to get, or today you're buying the house that fits your needs, that fits within your budget, that fits your family, and we can always refinance you out of that mortgage if the rates come down in the future. Don't bank on that changing. So that's really the two ways to look at it. You might be getting in at the absolute lowest. I don't think we're ever going to see those threes again, the 2.75s and the
It
threes.
was like decades long of zero interest money.
Yeah,
Boggles my mind.
it was both a good and a bad thing.
Yeah.
So I don't think we're going to see that again. But if we do and things come back, we can refinance you out of it.
Mhm.
A lot of those FHA loans have like a streamline refinance. VA loans, you can do the interest rate reduction loans. There are no cost. You can go in and redo your loan and get a lower interest rate. So there's definitely options.
Yeah. One thing I always try to tell my clients is, market conditions aren't really a go or no go on accomplishing your own goals. Like, you still have to live your life. If it's raining outside and we're playing soccer, that's what we're doing. We're just going to
Yep.
deal with the rain. If we've got high prices or tough competition or bad interest rates or whatever the story is, I feel like the professionals you're partnered with, our job is to help you get what you need, which is the house you want, or, start building equity or building wealth or whatever it is.
Yeah.
And we just have to use the market conditions to kind of inform our strategy for how we get you what you want.
Correct. You might look at a 7% interest rate, but when you're paying rent, you're paying 100% of that to somebody else. You're getting nothing.
I love that
You're
one.
off your head. So,
Yeah.
it's it's definitely, you hit the nail on the head. It's the way to build that wealth. You're building that equity. You're getting into the market, and you've got to get into the market somewhere. And it's like anything, it's going to come up a little bit, it's going to go down a little bit. It's
Yeah,
what
they
happens with
change
an
all the time.
investment. But now is the time, because we don't know what the future is going to hold.
So true. And one of the things I also wanted to highlight in the same kind of vein, something I've never done before, but have obviously started doing just this in the last couple months, is bringing lender recommendations to my listing meetings. So when I'm meeting with sellers, and helping to educate them about like what the interest rate is doing to their buyer pool. You used to have 25 buyers and now you have 5, and those buyers have 25 houses to choose from. It's a very different kind of market than we were in a couple of years ago. But now that I have I can't believe I never thought of this before. I guess I never really had to, but bringing that lender into the conversation, saying like, hey, we can partner with you to kind of help counsel and position ourselves really well so that we're competitive, giving good incentives to buyers to make your home more affordable that don't require you to come out of pocket $30,000.
Correct. It really truly is a partnership. And if you have a lender that you've partnered with and you're going into that meeting, that's an extra strength for you, because you have somebody that's going to be on your team with marketing. They're going to be on your team with the advisement if an offer starts coming in. Ideally, you've got a lender that you've partnered with, that your buyer's coming to, so that that it's going to close when it needs to close, that it's going to be taken care of the way that it needs to be taken care of. But at the same time, that buyer is structured right, so you're meeting the seller's needs with it, you're meeting the buyer's needs,
Yeah,
and you're going in and figuring out what all those numbers are. And so as you're going into that listing appointment, and it is a strength when you've got a lender partner, because you're like, hey, here's what I have. Maybe my lender's offering some incentives as well. Well, if you've got a lender that you partner with that's offering incentives, then that's going to be less money potentially that they're going to be asking that seller for in a seller credit, maybe to cover closing costs or buy the interest rate down, whatever that buyer needs. And that's an extra tool for you. It's an extra
exactly.
tool for marketing. It's an extra tool to bring solid buyers to the table.
But just so we're clear, the lender always works for the buyer. They don't actually
Correct.
work for the seller.
Correct. No, they
We're
do.
just helping position the
But you're
deal.
helping position the seller of, back to our original conversation, are you dropping that price because you're trying to hit a different price point? Or is there a lender that's working to say, hey, look, maybe we can do this, and this is what really truly makes more sense for that buyer?
Exactly.
So yeah, you are correct. I will probably
Um,
worded that a little weird.
But that does remind me, one of the things I wanted to ask you about, I saw this post on Instagram the other day about kind of some predatory lending practices that are happening. Um, since buyers are a little more desperate and kind of looking for solutions, there's apparently online lenders offering like huge credits and stuff like that. Are you aware of anything like that in the marketplace?
So I've heard of a few things. I haven't seen anything specific. I do know that what we've seen a lot is, credits being offset by fees. Um, so it kind of becomes a marketing thing. We can go right back to, I did see something the other day. They were advertising a loan still at like 3.75. And I'm like, there's absolutely no way, right? So it's going to obviously come with a really huge cost to get to that. I have no idea how they were even coming up with that. Um, I saw another one on an equity line of credit at like 2%. And I actually believe I commented on that post and said, hey, I'd like to know where you can find this, out of curiosity. But I think that some of those things are coming through, and it's the same thing that we've been dealing with, for a long time. If the rates were at 3.5%, you're going to see an advertisement because somebody's going to say, hey, look, so and so can give me 2.5. Well, what's the cost? So when you're comparing those things, if you're looking at that low rate, you want to actually compare the annual percentage rate, not just the rate, the actual annual percentage rate, because that's going to factor in the costs into what the true rate is on that. So if the costs are really high, your annual percentage rate is going to be higher.
Right. So, I mean, like kind of in regular person speak, the way that I hear that is if a lender's advertising something that feels a little too good to be true, they're probably making up whatever they're giving up here somewhere
Yeah,
in the
somewhere else.
paperwork
Yep.
where
And you can
most
always
of us aren't paying
ask
close
them.
attention.
Yep. Ask them for a loan estimate. So we've been doing a lot of that lately where maybe we have clients that are shopping us against someone else or someone else against us. And so it's, show me the loan estimate. Well, let's get on the phone and let's look and compare the two of what I've got versus, the competitor side by side. Just because the rate is lower does not mean it's the better deal.
Right.
Just because the
You
rate
really
is
have to look at
lower
all of the things.
does not mean that it is the best loan option for you or the best, the rate might be lower, but maybe, there's a mortgage insurance because it's the wrong program that is higher. Um, there's so many factors that can go into that. So lowest rate doesn't necessarily mean lowest payment or best deal.
So true. All right. Oh, another thing I wanted to ask is, do you think adjustable rate mortgages are going to come back?
They are coming back. It's kind of the hot topic. We're always pricing them out right now and looking at them, and there's varying reasons why we would do that. In the recent history, we haven't really been looking at those just because the fixed rates have been so low. But there's definitely a place for the adjustable rates, and I think that at the end of the day, it becomes a conversation. Um, you have borrowers oftentimes that maybe they're here on a temporary 3 or 5 year assignment with work, and they know that they're going to get reassigned to leave. They're only here for a short time. An adjustable rate right now makes a perfect solution for them because they know that their term in that home is not going to be for the next 30 years.
Mhm.
So in having conversations with clients and really finding out, what their plan is, there's varying reasons why that would be, you know, the option that would make the most amount of sense. Um, at the same time, kind of hedges you a little bit. What is the market going to do? We don't know. And so having that adjustable rate will give a little bit of flexibility, but some security in the near future.
That's cool. And then that kind of brings me to the last topic. I remember I was at the Fall Festival of Homes with a friend and having a great time. And this lady came out and was like, "Oh, the housing market's going to crash and all these people are going to be upside down." And I'm like, actually, that's not true. But she's like, "There's all these adjustable rate mortgages." And I'm like, no, there's not.
No, no,
So
there's a
we
lot
have
of
this like
3% fixed rate.
PTSD from 2008, right? Of like,
Correct.
we think that that's still how it works.
Correct. And I went through that recession in this industry. And so, there's a lot of varying things um, that can cause what happened in '08 and in '09. I think that if you look at the industry as a whole, there's been a lot of reform. We have a lot of new regulations. We have a lot of new underwriting guidelines. We have, a lot of things in place. And it was not just adjustable rate mortgages, and I don't even necessarily think that it was those.
That's
Um,
true.
there was a
Like
lot of
poor
leniency.
qualification for
Yeah,
people. Yeah.
there was a lot of leniency when it came to qualifications. There was a lot of stated income loans out there
Whoa.
for borrowers that maybe really shouldn't have had
I
them.
make $1 million, Amy.
Yep,
Can I have some money, please?
exactly. I work at a fast food company and my salary is $500,000 and this is what I want to buy. Whereas, there has been a little bit of stated income that has come back in the market, but it's more so for what it was intended originally. You've got a business owner with many different entities that are flowing
Oh,
back and
sure.
forth
Okay.
that maybe have all different tax reporting periods where that paper trail of documenting that income is really difficult. You can see that it's there, it's just, is it a clear stream? Your W-2 employees should never have been allowed to do something of a stated income. So we ended up with, yes, there were some adjustable rates, but we ended up with overinflated appraisals coming through. We ended up with, you used to be able to call your appraiser and say, hey, this is how much I need for this house. We don't get to do those things anymore. That was a very long time ago. And so there's a lot of industry standards that have changed in the last several years that give us some protection. At the same token, even if you look back at COVID over the last couple of years, lenders were putting programs in place to ensure that people were not going into foreclosure. There was programs there to help them get through payments. There was some relief. They were far more focused on working those situations out with people to keep them in their homes and keep them in their mortgages, not so much, hey, we just want to take this back and we want to repossess this, because that is a lot of what happened before. There really was no, we had a modification and it wasn't super clear or easy to go in and get a mortgage modification. And so it kind of forced some people into that situation. Whereas now you're looking, and when they saw an issue coming, they took the necessary steps to kind of wade through it and get both the homeowners, the borrowers, and the lenders through it all together. So,
Well, and I think foreclosures are like the lowest they've ever been, aren't they?
correct. Yeah.
Yeah, that's awesome. I mean, I
So,
can't believe we came through like world shutdown
yeah.
and had less foreclosures than we've had, normally.
Yeah. There was tools and options
Of course.
out there to
And the
help.
government shot money out into
No,
the universe quite a
and
bit.
there's that. But if you just look at, the programs that were put in there, and I run into different ones that, as I talk to people that have had them, you know, throughout this time, that, it's like, oh, well, that's really neat that they did that for you. And some of them were good and some of them weren't nearly as good. There was definitely a lot of people that kind of got sidetracked and didn't realize, well, that they hadn't made their payment for 6 months, but then they were going to owe 6 months all at once. Um, so some programs were a little better than others, but
Gotcha. All right. Well, that's sort of all my questions. Thank you so much for taking the time. I'll be interested to see if there's any feedback. And guys, I'm going to be here every week answering questions and kind of talking about the mortgage, the market. Probably mostly I'll be with lenders, but I'll also be bringing in some of my other team members, like inspectors and things like that, to just get your questions answered and help you guys navigate the real estate market like a boss. So I'll see everyone next Wednesday. And Amy, I'm sure I'll talk to you probably tomorrow.
so thank you for having me.
Yeah. Bye.
Bye.